Companies employ various long-lived assets to generate revenues in the operations of the business. The cost associated with the use of long-lived assets is called depreciation. To help your understanding, let's look at the assets of Joe's furniture store, specifically his delivery truck. Joe just bought this truck and plans on using it for 5 years. As the truck is used, it will show more and more signs of wear and tear. This wear and tear depreciates the value of the truck. Accounting for depreciation is not a matter of valuation, but a means of cost allocation. The cost of the truck is allocated to expense over the periods of use. These expenses are therefore matched against the revenue generated from using the truck. Thus, the long-lived asset is not depreciated on the basis of a decline in its fair market value, which is difficult to estimate, but on the basis of systematic charges to expense. When long-lived assets are written off, the term depreciation is most often used to indicate that tangible plant assets have declined in value. Where natural resources, such as timber, gravel, oil, and coal are involved, the term depletion is employed. The expiration of intangible assets, such as patents or trademarks, is called amortization. 3 basic questions must be answered in determining the amount of depreciation each period. 1. What depreciable base is to be used for the asset? 2. What is the asset's useful life? 3. What method of cost allocation is best for this asset? The answers to these questions involve several estimates. The base established for depreciation is a function of 2 factors, the original cost and salvage or disposal value. Salvage value is the estimated amount that will be received at the time the asset is sold or removed from service. It is the amount to which the asset must be written down or depreciated during its useful life. To illustrate, if an asset has a cost of $10,000 and a salvage value of $1,000, its depreciation base is $9,000. The service life of an asset and its physical life are often not the same. A piece of machinery may be physically capable of producing a given product for many years beyond its service life, but the equipment is not used for all of those years because the cost of producing the product in later years may be too high. In accounting for the asset, we use the service or useful life. The third factor involved in the depreciation process is the method of cost allocation. The depreciation method employed should be systematic and rational. In practice, various depreciation methods are used. In this tutorial, we discuss the following methods. 1. Straight line method. 2. Activity method. And 3. Double declining balance method. To illustrate these depreciation methods, assume that Joe's furniture store recently purchased a truck to make customer deliveries. The truck cost $45,000. Its estimated useful life is 5 years, or 100,000 miles, with an estimated salvage value of $5,000. The straight line method considers depreciation a function of time rather than a function of usage. Using the straight line method, the depreciation charge for the asset is computed as shown on the screen. The depreciation charge for each of the 5 years is $8,000. Alternatively, we can compute an annual rate at which the company depreciates the delivery truck. In this case, the rate is 20%, 100% divided by 5 years. When an annual rate is used under the straight line method, the company applies the percentage rate to the depreciable cost of the asset, as shown here. The activity method assumes that depreciation is related to the use or productivity instead of the passage of time. The useful life of the asset is measured based on either the output it provides or an input measure, such as the number of hours it works. Using the units of activity method, the depreciation charge per mile is computed as shown on the screen. Assuming that the truck is driven 6,000 miles during the first year, depreciation expense is computed as shown. Using assumed mileage for the remaining years of the truck's use, annual depreciation expense and book value is computed as shown. A third method for systematically allocating the cost of the truck to periods of use is the declining balance method. This method is one of the accelerated depreciation methods in which higher depreciation cost is recorded in the earlier years and lower charges in later periods. The declining balance method produces a decreasing annual depreciation expense over the useful life of an asset. A common declining balance rate is double the straight line rate. If Joe's furniture uses the double declining balance method, the depreciation rate is 40%. The formula and computation of depreciation for the first year on the delivery truck is shown here. Annual depreciation expense and book value for each year of the asset's useful life are shown here. In this table, we compare expense and book value of Joe's truck using our three depreciation methods. While different expense patterns result from application of these methods, at the end of the service life, the book value is the same. Let's take a quiz to check your understanding of depreciation.